Welcome to today's video where we will dive into the exciting world of investment strategies, specifically focusing on BST versus SHD. In the vast universe of investing, exchange-traded funds, or ETFs, have emerged as a popular and effective way to diversify a portfolio. Today we're going to focus on two specific types of ETFs, BST and SCHD. BST, or BlackRock Science and Technology Trust, is an ETF that primarily targets technology and growth stocks. It's a fund that seeks to invest in companies on the cutting edge, those that are pushing boundaries and shaping our world with innovative technologies and services. If you're someone who appreciates the power of technology and its potential for growth, BST might just be your kind of ETF. On the other hand, we have SCHD, or Schwab US Dividend Equity ETF. Now, this ETF takes a different approach. SCHD focuses on high-dividend, blue-chip stocks. These are well-established companies with a history of providing steady dividends to their shareholders. The SCHD investment philosophy revolves around stability and consistent returns, making it a preferred choice for many conservative investors. So in essence, we have BST, a fund that leans towards technology and growth, and SCHD, a fund that leans towards stable, high-dividend yielders. It's important to note that neither of these strategies is inherently better than the other. They simply cater to different investment preferences and risk tolerance levels. As we delve deeper into the comparison of BST and SCHD, we'll explore their performance, risk and return analysis, and dividend analysis. We'll look at the pros and cons of each, their historical performance, and how they might fit into your unique investment strategy. Now that we have a basic understanding of what BST and SCHD are, let's start comparing them. If you are enjoying this content, and you do not want to miss future videos filled with even more tips, tricks and inspiration, hit that subscribe button now to stay tuned with us, and remember to comment and share. First, we'll compare the performance of BST and SCHD. Now, when we talk about performance, we generally mean how well these funds have done over a specific period of time. So let's take a look at the last 5 years. Let's start with BlackRock Science and Technology Trust, or BST. This fund has shown to be quite a performer with strong annualized returns. The fund's focus on technology and science sectors has allowed it to take advantage of the tech boom and deliver impressive results. However, with high reward often comes high risk, and BST is no exception. Due to its sector-specific focus, it has experienced periods of volatility that might make some investors a bit uneasy. Now let's shift our gaze to SCHD, the Schwab US Dividend Equity ETF. SCHD takes a different approach, focusing on high-dividend yielding US stocks. Over the past 5 years, it has offered solid and consistent returns to its investors. It's not as flashy as BST, but its steadiness might be appealing to those who prefer a less volatile journey. So, what are the key differences in their performance? Well, BST tends to deliver higher returns, but with that comes increased volatility. On the other hand, SCHD provides consistent, albeit slightly lower returns, with less volatility. It's like comparing a roller coaster ride to a scenic train journey. Both can get you to your destination, but the experiences along the way are quite different. In essence, the performance of these funds is highly dependent on market conditions. BST thrives in a booming tech sector, while SCHD benefits from a stable and high dividend-paying market. Moreover, the investment focus of each ETF also plays a pivotal role in shaping their performance. BST's tech-centric approach contrasts with SCHD's dividend-driven strategy, leading to different risk and return profiles. As we can see, performance varies depending on market conditions and the investment focus of each ETF. In the end, it all boils down to your investment goals and risk tolerance. Both BST and SCHD have their own unique strengths and potential drawbacks, and understanding these can help you make a more informed investment decision. Now we'll analyze the risk and return of both ETFs. When we dive into the world of investing, it's like stepping into an arena of risk and return. It's a dance, a balancing act, where we try to maximize our returns while minimizing our risks. And today, we're examining this dance in the context of two ETFs, BST, BlackRock Science and Technology Trust, and SCHD, Schwab US Dividend Equity ETF. Let's start with BST. BST's main focus is on growth stocks, particularly in the science and technology sectors. Now, these sectors are known for their high potential for returns. Think of those tech giants that started as small companies and exploded into industry leaders. That's the kind of growth we're talking about here. But with high returns also comes high risk. The tech sector can be volatile, subject to rapid changes and disruptions. One day you're on top, the next you're struggling to keep up with the latest innovation. So while BST might offer the potential for high returns, it also carries a higher level of risk. On the other hand, we have SCHD. SCHD focuses on dividend stocks, which are generally companies that are well established and financially stable. These companies are not as likely to offer high growth rates, but they do offer steady, reliable returns in the form of dividends. The risk with these stocks is typically lower, as these companies are less likely to experience significant volatility. However, the potential for return is also capped, as these companies are already at or near their growth peak. So, in a nutshell, BST's focus on growth stocks might lead to higher returns but also higher risk, while SCHD's focus on dividend stocks might lead to lower returns but also lower risk. It's a trade-off, a balancing act, and the scales of this balance will tilt differently for each investor. Thus, the choice between BST and SCHD can depend on your risk tolerance and investment goals. Next, let's delve into the dividends of BST and SCHD. One of the most attractive aspects of investing in exchange-traded funds or ETFs is the potential for dividends. Dividends, as you may know, are a portion of a company's earnings that are distributed to shareholders. They can provide a steady stream of income in addition to any potential capital gains from the increase in the ETF's share price. Now, when we look at BST and SCHD, we see two different approaches to dividends. SCHD, or the Schwab US Dividend Equity ETF, focuses primarily on dividend-paying stocks. This means that their primary goal is to provide investors with a steady, reliable stream of income. As a result, SCHD has a relatively high dividend yield. This yield is calculated by dividing the annual dividends paid by the price of the ETF. On the other hand, we have BST, or the BlackRock Science and Technology Trust. This ETF focuses more on growth stocks, which are companies that are expected to grow at an above-average rate compared to other companies in the market. These companies often reinvest their earnings back into their business to fuel this growth, instead of paying out dividends. As a result, BST has a lower dividend yield compared to SCHD. However, it's important to note that a higher dividend yield isn't always better. While it can provide a nice source of income, it can also indicate that the company isn't reinvesting as much in its growth. This could potentially limit the company's long-term potential. On the flip side, a lower dividend yield, like BST's, could indicate that the company is investing more in its growth. This could lead to higher capital gains in the future. In the end, it all comes down to what you, as an investor, are looking for. If you're looking for a steady source of income, then SCHD and its higher dividend yield might be more appealing. But if you're more interested in potential capital gains, then BST might be a better fit. Therefore, if you are an income-focused investor, SCHD might be a better choice. In conclusion, both BST and SCHD have their own unique advantages and disadvantages. We've journeyed together through the fascinating world of these two investment vehicles, understanding their performances, risks, returns, and dividends. Let's take a moment to revisit the key highlights of our discussion. We dove into the performance of both BST and SCHD, and discovered that while BST may offer higher potential returns, SCHD leans towards consistency and stability. It's like choosing between a high-speed race car and a reliable family sedan. Each has its place depending on the road you're traveling and the journey you're planning. We then explored the risk and return analysis. We saw that while BST may involve higher risk, it also tends to provide higher returns. On the other hand, SCHD offers a lower risk profile, making it a potentially safer bet for those with a lower risk tolerance. In terms of dividends, we found that BST tends to offer higher dividends, which might suit those looking for regular income from their investments. SCHD, however, provides more predictable dividends, which may be attractive to those who value stability and predictability. The choice between BST and SCHD, therefore, is not a matter of better or worse. It is about aligning your investment with your personal goals, risk tolerance, and income needs. It's about understanding your financial journey and choosing the vehicle that will best help you reach your destination. Remember, the most successful investors are those who take the time to understand their investments and make informed decisions based on their individual circumstances and goals. So take what you've learned today and use it to make your investment decisions more strategic and effective. Thank you for watching. If you found this video helpful, please subscribe, like, and share with others who might find this information valuable. Stay tuned for more informative videos on investment strategies.